On a quiet Thursday morning, something strange began happening across America. Thousands of people opened their banking apps, not because they were panicking, not because they needed cash, but because a feeling didn't sit right. Balances were still there. Numbers still looked normal. But when they tried to move their money, nothing happened. No error message, no warning, just silence. Within hours, founders were calling investors, executives were calling lawyers, and regulators were waking up to a problem they hadn't seen coming. This wasn't a cyber attack. This wasn't fraud. This wasn't theft. This was something far more dangerous. A complete loss of confidence. For decades, Americans were taught a simple rule: put your money in a bank. That's where it's safest. Banks were regulated. Banks were insured. Banks were stable. Or at least, they were supposed to be. But the modern financial system has changed. Money now moves instantly. Fear spreads faster than facts. And trust can collapse in hours, not years. Today's story is about a bank that followed the rules, played it safe, and still collapsed faster than anyone thought possible. A collapse that erased $6 billion and exposed a weakness that still exists today. This bank wasn't famous. Most Americans had never heard of it. It didn't target everyday people. It didn't open branches on every corner. It didn't advertise credit cards or home loans. Instead, it quietly became the financial backbone of Silicon Valley. When a startup raised money, this bank held the cash. When venture capital firms closed deals, this bank processed the funds. It specialized in one thing: serving companies with large balances and complex needs. By the early 2020s, the bank was holding over $200 billion in deposits. That kind of growth should have raised questions. But it didn't, because everything looked fine. Here's where the first problem appeared. Most banks have millions of customers. Some withdraw money. Some deposit money. It balances out. This bank didn't have that. Its customers were startups. And startups behave very differently. They raise large amounts of money, then slowly spend it. When the tech economy slowed down, startups stopped raising money. Instead of deposits flowing in, money started flowing out. Quietly at first, then all at once. Banks don't keep your money in vaults. They invest it. This bank invested heavily in long-term U.S. government bonds. On paper, this was the safest choice possible. Government bonds rarely default. They're considered risk-free. But there's a catch most people don't understand. When interest rates rise, bond prices fall. And in 2022, interest rates rose faster than at any point in modern history. Suddenly, those safe bonds were worth billions less than what the bank paid for them. The losses were real, but hidden. As long as no one asked for their money back. Banks don't fail when they lose money. They fail when people stop believing. The bank could survive paper losses. It couldn't survive panic. And panic doesn't need proof. It only needs a trigger. That trigger came quietly. A respected investor warned founders to move their money, just to be safe. No public announcement. No headlines. Just private messages. But startups talk to each other. Group chats lit up. Emails spread. Fear multiplied. By the end of the day, customers attempted to withdraw $42 billion. In one day. No bank in the world can survive that. This wasn't like 1929. No crowds, no lines, just phones. Money moved instantly. The bank tried to raise cash by selling bonds. But selling confirmed the losses. Confidence vanished. The stock collapsed. By the next morning, regulators shut the bank down. 40 years of history ended in less than 72 hours. This wasn't a reckless institution. It followed the rules. That's what scared regulators. If this bank could fail, others could too. And panic spreads faster than logic. Normally, deposits are insured up to $250,000. Most customers had millions. If they lost access, startups would collapse. Jobs would disappear. So the government stepped in. They guaranteed every dollar. Not to save the bank, but to stop the panic. This wasn't about greed. It was about assumptions. That interest rates would stay low. That fear would stay slow. That the system couldn't break overnight. All of those assumptions were wrong. Your money isn't sitting still. It's part of a system built on trust and timing. Most days, it works. But when fear spreads faster than understanding, everything breaks. The next crisis won't start on Wall Street. It'll start in a group chat. And when it does, the people who understand the system won't panic. They'll prepare. Because the most dangerous belief in finance is thinking it can't happen again.